Today, I'll be discussing dollar cost averaging, and we'll be looking at how a regular savings habit can help your clients make money even in a negative market cycle.
Dollar cost averaging is an extremely popular strategy to help clients cope with volatility in market cycles. An example of how this might be used is you've got a client who has $120,000 that they wish to invest, and they're planning on doing it as a lump sum, but because it's a lump sum they're fearful of placing all their money in at once, because they fear that if they've picked the wrong time to go in, so say at the top of the cycle, they fear that they might experience a significant fall, say 20% fall in this example, down to 96,000, and then they would sit there and hold on and ride that volatility out until it recovered back to 120. And as what most clients do is, if they've had a negative experience, as soon as they've broken even, they get out and run for the hills. Now in this example, a 20% decline would require a 25% recovery to get to that break-even point. Let's assume this same client received advice to say, rather than placing the 120,000 in as one lump sum, we break it up so that every month we make a $10,000 deposit over the 12 months. What this does is it allows a client to invest that 120 over a period of time, and say that over that 12 months they've experienced the downturn and the recovery. It makes their return a lot more palatable, because rather than being at break even 12 months later when they've made their final deposit, they're actually going to be well ahead, because each of the deposits that they've made during the market downturn will be carrying a profit when they get back to the break-even point in the 12th month. So that this client, rather than having 120,000 at the end, will have significantly more than 120,000, even though the market has gone down and just recovered back to its starting point. So dollar cost averaging in a falling market can be quite a profitable exercise. However, the risk there is that in a falling market it will reduce risk, but in a rising market dollar cost averaging will dampen or reduce your overall returns. So it is a risk mitigation strategy. So what that means, risk mitigation means it reduces the volatility, so your losses aren't as big but your gains aren't as big either. The key thing that we've found with advising clients around dollar cost averaging is that it helps investors overcome the paralysis of investing. Many clients are so fearful of, I don't know when to put my money in, that they just don't invest. By breaking up their lump sum into smaller, palatable investments, an investor is more likely to, one, get into the market, but two, understand the market and start to appreciate the volatility, and they almost hope that if they're investing, for example, on the 15th of each month, they'll keenly look at the markets on the 14th of the month and think, oh, I hope it goes down so that tomorrow I can buy at a lower price. And it encourages investors to become more familiar and accepting of volatility, knowing that it's a buying opportunity. But in a nutshell, that's how dollar cost averaging works.
This has been Eddie from Curto Consult. Thanks for watching.